sessions, the speed and depth of the downturn driven by the outbreak of coronavirus, as well as the initial recovery, have been much more pronounced and faster. For the most part, the speed of recovery is owed to the tremendous amount of fiscal support expended by governments to compensate for lost incomes. Nonetheless, as we approach the end of the year, output gaps remain that are as large on average as at the depth of the global financial crisis 10 years ago. The resurgence of the virus sweeping Europe and the US at this time in a second wave will create a double dip in economic activity through the winter. So we should expect negative GDP prints for Q4 and possibly Q1, but good news at the medical front in terms of availability of effective vaccines and therapeutics suggests that there is light at the end of the tunnel, finally, and that global growth should pick up significantly in Q2 as normalization takes hold. Despite rising expectations of reflation, continued intervention by central banks will ensure that the interest rate environment remains benign. Not only at the short end, with policy rates locked at 0 or below for several more years, but also for bond yields at the long end of the curve, where central banks will try to moderate and counteract any sustained rise of yields with their asset purchase programs. However, there are tail risks. Consensus opinions suggest at this time that there is no risk of rising inflation in the near term. However, unlike 10 years ago, where similarly loose monetary policy proved unable to generate sustained price pressures in the real economy, this time around, governments are not pursuing austerity programs. On the contrary, fiscal spending and deficits are setting records, and popular sentiment is that public debt levels no longer really matter. In fact, inflation expectations in the US by now have fully recovered to pre-pandemic levels already. And as such, inflation overshooting to the upside in fairly short order, in our eyes, cannot be ruled out as normalization of public life takes hold and mobility returns to normal. For investors, this suggests favoring inflation-linked instruments. In the US, for example, TIPS in the portfolio or other inflation-linked instruments, certainly when it comes to long duration exposure in the portfolio. The other big issue confronting investors with respect to the fixed income allocation is the fact that US Treasuries have joined the rest of the OECD government debt space in no longer offering much in terms of yield. This has led to a wholesale migration into corporate bonds, not the least encouraged by the Federal Reserve joining the ECB in taking the unprecedented step of providing a backstop to credit risk. Consequently, pricing of corporate credit has lost any connection with fundamentals such as default rates, rating changes, and debt levels, pretty much across all rating ranges. This argues for selectivity and close monitoring of credit markets on behalf of investors, for signs of waning confidence in central banks' ability to keep the markets propped up artificially. The US dollar has already started to weaken in recent months as liquidity has returned to capital markets following the turmoil of the spring. We believe that the tremendous financing needs of record dual deficits in the budget as well as the current account will maintain pressure on the dollar over the coming year. Emerging market currencies stand to benefit the most as global growth recovers. With respect to the Swiss franc, the fact that the Swiss economy has fared substantially better so far than most European peers, and the continuing allure of the Swiss currency as a safe haven suggests to us that the Swiss currency will continue to exhibit strength, not only against the dollar, but also the euro over the coming year. If you would like to get more insights about our Outlook 2021, please send us a message.